I'm Michael Waldron, Director of Portfolio Management at Heritage Financial Services. Thank you for watching my presentation of the Real Deal Economy. The primary market theme concerns the Fed's actions with respect to the federal funds rate. Connected at the hip are inflation data and whether it's appropriate for the Fed to move from neutral to stimulative policy. It's important to look back to understand where we are today. The first note is that inflation has been 3 to 4% year over year, measured each month since the summer of 2023. It's now a full year running at a moderate rate, nowhere near the disruptive rates seen throughout late 2021, 2022, and early 2023. With the Fed funds rate 2% higher than realized inflation, real returns on safe assets appear attractive. Shelter inflation is a component that remains concerningly high and is the primary reason the economy isn't seeing overall inflation closer to 2%. I recommend closely monitoring the residential property market, and if properties start to stay on the market longer and transfer at instead of above recent comparable sales, it might be the sign that inflation is going to approach 2%, and the Fed will have the bright green light to lower rates towards an equilibrium level. This is a positive narrative for fixed income. As it stands, real yields look attractive, and there is a potential tailwind if the economy settles into the 2% inflation range, allowing the Fed to reduce short-term interest rates. We've been saying this since the fourth quarter of 2023. Looking year to date, the peach segment shows fixed income has produced effectively no return thus far in 2024. Interest has been offset by price reductions. That results in some impatience with the asset class, particularly with equities producing strong returns. But please remember the fourth quarter in which fixed income produced a return over 6%. The fact is, fixed income has been moving in the right direction since late 2023. Let's zoom out and look at the important role fixed income plays in a diversified portfolio. Since 1976, 43 of 48 years, that's 90%, saw a positive return. Until 2022, the worst return during this long period for fixed income was negative 2.9%. Fixed income was up during the dot-com bubble bursting and through the lost decade for the S&P 500. It was up in 2008. Yes, 2022 was painful for an asset class that typically provides stability, but current yields more in line with the long-term history. And there is no doubt that the asset class has an important purpose for overall risk management and cash flow management. Put some numbers behind that comment. Let's break down the 5-year Treasury at June 30th. The yield component is 4.33%. If yield to maturity rises by 1% over the course of the year, the price will drop by 3.52%. That still leaves a positive total return. On the other hand, if the yield to maturity falls by 1%, the yield will be supplemented by price movement for a total return over 8%. Anywhere in the middle is obviously positive. This is how the asset class has such a great track record of positive returns. It would take a lot for a high-quality fixed income portfolio with a starting maturity around 5 years to be down over a full 12 months. And even if it happened, the downside for all reasonable scenarios is pretty shallow. And let's examine past cycles when the Fed stopped hiking the federal funds rate. Generally, declining interest rates are good for financial instruments, whether equities or fixed income. Assuming the final rate hike is July 2023, and that marks the starting point. Strong equity returns since then are right in line with historical experience, seen on the chart to the left. Switching over to fixed income, the chart on the right, returns since July 2023 show a lag compared to historical experience. Provided the Fed starts easing as inflation reaches its target, there is fuel under the asset class. There is nothing wrong with equities, but fixed income presents more reasons to be positive on the asset class compared to its historical record. I want to reiterate that equity returns seem completely justifiable. Remember, while 2022 was a bad year for fixed income, it was a worse year, at least in absolute returns, for equities. From the end of 2021 to the beginning of 2024, the cumulative return on global stocks was effectively nil. Meanwhile, GDP increased each quarter, showing impressive economic growth. Is it a surprise that 2024 has been a good year for equities? Not really. And a 10% cumulative return over 2.5 years isn't exactly an overheated market from which to shy away. But what about politics? What about the presidential election that we're going to have in November? Many of us have passionate political views. That is healthy. But at least in the limited sphere of an investment portfolio, please don't let politics throw you off of a good long-term plan. In the US equity market, through Democrat and Republican administrations, growth and positive returns have been the enduring theme. We live the day-to-day, which can be stressful. For a long-term portfolio, supporting a long-term financial plan, it's critical to remain disciplined and not let politics throw you off. So what's the real deal? With strong equity market returns in 2023 and the first half of 2024, the common reaction is to want more of that asset class. Meanwhile, bonds are mired from their 2022 return, such that many question the value of the asset class. I believe this is a mistake, and fixed income is being underestimated in the value it provides in a diversified portfolio. Fixed income is set up well from a yield standpoint, and where we appear to be with respect to Fed policy, approaching the beginning of a rate cutting cycle. Between interest and price movement, fixed income can be an important return driver in the upcoming years. And finally, don't let the election throw you off your long-term investment plan. The march of markets is upward, and you want to participate. Thank you for your time, and I hope you tune in next quarter as we dig into the economic data and sort out what to ignore to get at the real deal.